The question is it just a pullback to support right here? This is where you should have support right around 20,400. If it holds that, maybe it gets another up move. I'm still in the camp, though, that when all is said and done, 6-12 months from now, we're going to have seen crypto and Bitcoin go down quite a bit more before all is done.
Hello everyone and welcome to the Daily Crypto. We are back with another news-packed video for you to enjoy. And this time we have the master trader himself with us, Gareth Soloway. He is going to share his insights with us shortly right after we take a look at the Fear and Greed Index. As of recording this video, the FNG index is at 20, down significantly from yesterday's 28. Currently Bitcoin and Ethereum are trading for 19,700 and 1,459 respectively.
And the key is going into this number, honestly, I was in the 50 basis point camp because looking at gas prices, oil, copper, all these commodities have fallen dramatically. And so in my head, I'm like, okay, well, we should see that trickle through to the consumer price index. And we just did not. And I think the market got caught way off guard. The Fed now is locked in at 75. I think that's a no-brainer. The reason why I don't think there's 100 is because technically the Fed is really tightening additionally by unloading their balance sheet. So I believe in September, they started to reduce their balance sheet. And by reducing their balance sheet, it's technically a tightening effect as well. So if they do 75, it probably, with the unloading of their balance sheet, it's the equivalent of 100 basis points. So market does not like it. Crypto doesn't like it. Stocks don't like it. It's just risk off all the way around.
In the recent Fed meeting, it has been decided that interest rates will be hiked by 75 basis points. This is extremely bearish for the economy as money is essentially being sucked out of the system with policies like these. Risk assets like Bitcoin will be the most affected, which is why Gareth believes that 12 to 13,000 Bitcoin is very likely in the near term.
But I think the biggest thing here is the Fed really, and this is what I've been, yelling at the top of my lungs, is the Fed has to be so careful here, because if they trigger a bad recession, ask yourself, how do we get out of that recession? Because every past recession we've gotten into over the last 10, 20 years, the Fed has printed us out of. And if inflation is as sticky as it looks, they can't do that in the future. And so if they trigger a bad recession, we may be stuck in that recession for years. And we may have stagflation, all these negatives. And I think that's a real thing. If I was on the Federal Reserve Board, which I'm not, but if I was, I would be saying, Jerome Powell, be careful here, because you go too hard and too heavy, you're going to trigger this recession, and then we can't get the economy out of that recession.
Gareth says that with Fed hiking interest rates at this pace, there is a huge risk of crashing the economy into a deep recession. What does the government do to get out of a recession? You guessed it right. Print trillions of dollars and inject them into the economy. This is even worse because sooner or later, the economy will fall down even harder.
So usually the way it works is that the markets, after today's data, they're readjusting very, very quickly. There'll probably be an additional readjustment for the next couple days. And then by the time you get to Friday, the markets will probably be priced in to 75, maybe 100, and they'll just sit there and kind of go sideways until we get that data from the Federal Reserve. So the market is in that. So anytime the market gets information it didn't expect, it quickly tries to readjust to factor those expectations in. And then until it gets new information, it'll kind of hover around that level. So that's what I'm expecting, some volatility the next few days and then getting into a quiet period.
Whenever the markets go sideways for a while, as soon as big news comes out, the price action tends to go crazy for a short period of time, but then returns back to normal. This is what Gareth is expecting to happen after the recent Fed meeting.
Yeah, what it tells me is that the supply chain is still an issue. That's still keeping prices up. It also tells me wage pressures mean that companies have to charge more for their products because they're paying their employees so much more over the past 12 months. And all of these are then negating the drop in oil. I mean, imagine if oil was still at $120 a barrel, where we would be at that point.
Oh my God.
So, it's definitely not a good position. And you can see from the market reaction, it freaked out the markets. I mean, this was, in terms of a trader's dream, this is what you love. But an investor, man, you just shake your head at it and you kind of just look to fight another day.
Inflation is slowly creeping down, but prices for everyday items are still relatively unchanged. This is because companies need some time to readjust to the current inflation rates, and they will continue to pass on the excess cost to the consumer until things get better again.
Crypto-wise, I mean, you're seeing Bitcoin get slammed today. That's a nasty fall on Bitcoin. Now, interestingly enough, it came after 6 up days in a row. So 6 up days, you could argue that you were due for a pullback. The question is it just a pullback to support right here? This is where you should have support right around 20,400. If it holds that, maybe it gets another up move. I'm still in the camp, though, that when all is said and done, 6-12 months from now, we're going to have seen crypto and Bitcoin go down quite a bit more before all is done.
Bitcoin took a massive hit as it dropped down to 20,700, and Gareth says it has to hold 20,400 support or else it will continue to free fall and eventually break below 20,000 once again.
Yeah, so I think that's definitely a chart you want to pay attention to, because just like the individual charts of the cryptocurrencies, it does tell a story. So it tells you about how much money was chasing at the highs. The head and shoulders, like you said, is absolutely crystal clear there. And interestingly enough, one interesting comparison, at the height of the dot-com era, guess what the market cap was of all the dot-com stocks? Right around $3 trillion. So a weird parity there as well with the cryptocurrency top, which was right around 3 trillion as well. And now we're kind of living through that dot-com blow up of the crypto markets.
The total crypto market cap is a great chart to analyze the money inflow and outflow. It clearly formed a bearish head and shoulder pattern which ultimately broke to the downside, and we saw more than 50% of total market cap being wiped out. However, there is an interesting catch, as Gareth points out. At the time of the dot-com crash, the total stock market cap was also $3 trillion.
I was in the camp of 50 and then an additional 25 into year end. I think you have to think 75 now. This is the 10-year yield chart. 10-year yield is nearing that 3.5 double top. So again, I don't know if we'll double top and pull back here, which would indicate that markets start to think the Fed may do the 75 and then kind of sit on the sidelines. But it certainly is something I'm watching. But I would say, again, what I hope the Fed does is, if they're going to do 75, I hope that they sit on the sidelines for a couple months for the sake of the economy, for the sake of everyone else. I do think inflation will come down. It's just kind of lagging at this stage. And so I just hope that they don't overdo it too much, push us into a dramatic recession. Then you see unemployment go sky high, 8%, 10%. And I do worry that that could be what the path they're on. So going into year end, I mean, I hope that they only do another 25 after this next one.
The 10-year bond yield has been a great indicator of the economic conditions, and it has been at its lowest whenever Fed has hiked rates to this extreme. But so far, it continues to rally and is about to test the previous highs. Gareth says it is possible that we see a double top formation and it starts to trend lower from there.
The inflation we're seeing is in spite of a 15% strengthening of the US dollar since the start of the year. So imagine if the dollar was flat or negative on the year. That's the one saving grace, I think, that at least if you go to another country, like you can go to Europe right now or Japan, and your dollar goes really far in terms of taking a nice vacation. But needless to say, it is the dollar. And by the way, it's very rare for the dollar to go up and the bond market to drop, meaning yields going up at the same time. That is super, super rare. Not a good scenario at all. That's kind of like the death march, if you will, for the overall economy. So it's something that, again, people are going into the dollar because of safety. They're very concerned about geopolitical things, Russia, Ukraine, China, Taiwan. Then you throw in potential global recession. That's making people buy the dollar. Then the Fed is tightening, which is sucking dollars out of the system. That's strengthening the dollar as well. So all of these factors are kind of coming together to create what I would worry would be that black swan event, where you could get some major breakage in the system.
Inflation has been at its peak, even though the dollar has strengthened 15% year to date. Things could have been dramatically worse if the dollar stayed neutral or went negative strength-wise. Think of what's happening in Europe at the moment. The euro has been constantly depreciating against the dollar, and inflation has affected Europe much more than the US. Gareth says all of these events could one day combine, and we might see a new global financial crisis.
I mean, I'm still thinking that there's, I mean, again, depending on what the dollar does and what risk assets do, but if things calm down and maybe the Fed isn't as hawk, I mean, this is the kicker, right? Is that next week with the Federal Reserve, everyone's going to expect the most hawkish commentary that we've ever seen from the Fed. It's possible that he might just be slightly less hawkish than the markets are fearing, in which case you could get one more push up in cryptocurrency, in risk assets, off of that. In fact, that's if we were to sell off going into that meeting and continue to sell off sharply, I would start accumulating some longs, maybe crypto longs as well as stocks, going into that thinking that, okay, the markets are pricing in this ridiculously hawkish Fed. If he's ridiculously hawkish, we've already priced it in, right? But if he's just ever so slightly less, maybe the markets get a bounce there. So I'm going to be watching really closely. I think Ethereum, again, if you get the merge to go smoothly, you might get a little bit of relief. I think it's short-lived, but I do think, again, you might get a little bit of relief back up. Maybe the 200 MA is one thing I'm looking. I mean, this would be a best case scenario to touch that 200 MA. It's also kind of a double top. But again, it's tricky now that the CPI number did what it did.
With the ETH merge in place, Gareth says the only thing that can move the market in an unexpected manner is that Jerome Powell doesn't come out as hawkish as the investors think he is. If this were to happen, we will surely see a run-up in stocks and cryptocurrencies, which is why Gareth says he is going to look for potential long opportunities. Thank you for watching, everyone. Like this video and subscribe to our channel so you can continue to watch educational content like this on a daily basis. See you guys in the next video.